Okay, so here we are, Rider C to the FARBAR contract. Rider C deals specifically with seller financing. Some people call it a purchase money mortgage. It's basically is the seller is acting as the bank. It's most often used in a first mortgage. This rider references a second mortgage, but most of the time you're dealing with it, it's on a first mortgage situation. Let me just part out here with a note. Again, you need to listen to the whole audio is best, but things used to be a lot easier. See my note here. Things used to be a lot easier for owner financing, and now after the fallout of 2008, many more restrictions are in place on owner financing, all right, because they don't want owners to be acting as banks and not abiding by the same rules. So the first page of this is something that's new. When I say new since 2014, but is all based upon Dodd-Frank, which came out after 2008, basically. The seller, if he's going to attempt to use owner financing, has to abide and comply with one of these exclusions, so you can say he's not a bank. So let's just start with the warning. All right, the warning, the seller and the buyer need to seek legal counsel to make sure that they can comply with the exclusions that fall under this, right? It starts to explain that as of January 10th, 2014, that if a seller could be accused of acting as a bank and have to be exposed to all the things that a Truth in Lending Act that a bank has to do, there are some exclusions, and they have two different exclusions, and I'm going to go over them briefly, but you need to understand them, and at least your seller, more importantly, needs to understand them. It's called the one property exclusion, where the seller is only financing one property in a 12-month period. He's not like a dealer. He's not doing many of these, okay? So he's only doing one property in any 12-month period, and he owns the property and is a natural person. It means he's an American citizen or the rights to do that, okay? The seller did not construct or act as the contractor, so he wasn't a builder of this place, so he's not building it and lending, all right? The financing does not result in negative amortization. Hope you know what negative amortization means. Negative amortization is a situation where the monthly payment is not even enough to pay the interest on the note, and therefore the principal amount goes up each month. So that's called a negative am. So no negative am is allowed. And the financing is a fixed rate or an adjustable rate that does not adjust for the first 5 years. Okay. That's number one. Now, if they have the three property exclusion, which means no more than three, so let's say they do more than one, but less than four, right? They still have to own the property as a natural person, did not construct, not act as the builder or the contractor for this. The loan is fully amortized. Specifically, there is no balloon. The first one allows for a balloon payment, which most owner financing looks for a balloon payment. We'll discuss that later on when we get into the actual note section or to the structure of the note. But this case, it'd have to be a fully amortized loan, meaning there is no balloon. The financing, again, has a fixed rate and doesn't adjust. And finally, they also have an added thing that the seller determines in good faith that the buyer has the reasonable ability to repay the loan. Okay, well, they don't want people taking advantage of people, but that is one that's not objective. That's a very subjective term. So you got to make sure you're not feeling like, hey, look, you could be accused. The seller could be accused of lending even though they had no expectation of being repaid. That, hey, look, this is just an automatic default, but I'll take their down payment, let them write it out, foreclose, and take the property back. All right. So if they meet one of the two criteria above, then they can use the following seller financing rider. If they do not, then they need to seek legal counsel. It's what these next two paragraphs say. All right, so let's get into the nuts and bolts of this. This is what a seller financing clause used to look like, but now they have that special Dodd-Frank notice on the front side. Let's read my note at the top here. Please note that below is a breakdown and summary of the structure of the owner financing. If, for example, the sale price is $200,000 and the buyer was putting 20% down, $40,000 as a down payment, then the mortgage noted would be for $160,000. What we're doing here is not a note or a mortgage. Many title companies will prepare a note and mortgage for the buyer and the seller based upon the structure that they have agreed upon in one of these options below that we're going to go through. This is just an agreement on how the note and mortgage will be created. If the title company, by the way, does not want to or is willing to create the note and mortgage, then the buyer and seller will have to negotiate who's going to pay for an attorney, or each side's attorney will negotiate who's going to create the note and then review it as well. Okay, so seller financing, we're going to get a hold of that. All right, it's going to be either a first or a second purchase money mortgage, which again is a note executed by the buyer, and the principal amount of, in this case, the scenario I just went over would be $160,000 at, let's say, 6% interest per annum. That would be the annual interest rate. Just as a side note, seller financing generally expects more down payment and higher interest rates. Why? Because most people are getting seller financing because they can't get traditional financing from the bank. So if that's the case, they're maybe waiting for an extra year of tax returns to come in because they became self-employed or whatever the case may be. The other thing I want to note here, I just thought of, is that people think that Future Home Realty, we don't allow owner financing. I do allow owner financing. I don't allow lease options, and the reason, or at least lease options have to be approved by me in advance. Owner financing I'm okay with, because when a buyer is putting 20% down or something like that, at least at the closing, the deed is being transferred over to the buyer. That's what owner financing is. Lease options, that's not the case. The seller retains ownership of the property, and a lot of times the buyers put a lot of money down and there's risk involved there. That's why I don't allow them without you running the scenario by me and taking care of that. So anyway, then out of these, we're going to choose one of these options. A fully amortized loan, all right? So let's say, and it defaults to 30 years. Let's say they say, hey, look, the seller says, you know what, I got plenty of cash. I'll loan them money. I'll let them amortize it over the next 30 years. Could be 15 years, whatever. This is more like a typical bank loan. There is no balloon payment. And I note here on the comments that this is a rare occurrence in owner financing. Generally, you'll see here, so we're going to see C, which is a balloon payment. There is an interest-only mortgage that, again, they pay only the interest, so it means whatever you figure out, it's interest-only. It's not fully amortized. You start at 160, and let's say it was for 60 months. They're making interest payments along the way, and then 60 months into this, they still owe 160 because they have not paid any toward the principal. That would be option B. Option C, again, as I mentioned, is a more typical scenario where there's a balloon mortgage that, again, they can only do that if they are they one property exclusion person. And note that here, typical in this case, let's say it's 160,000 at 6% interest rate. And they're going to amortize that over 30 years. So it's going to pretend like it's a 30-year loan, like we're going to spread this out. But at the end of 5 years, there's going to be an amount still owed. In this scenario, probably closer to 157,000 still. Remember, most of the payments in the early years are interest only, or interest anyway, not interest only, but interest anyway. But a portion does go to principal, so it will be reduced somewhat, but just not a whole lot. So at the end of 5 years, there's still 157,000 owed. The seller has the right to demand that entire payment. Now, either the buyer comes up with that in cash, or they go out and get refinanced so that they can then get out of this mortgage and into another. All right, and an adjustable rate or Part D. So that's number C is more common. A D is an adjustable rate mortgage for a minimum term. It gets in a lot of detail here. I rarely see adjustable rate mortgages on owner financing, but if they are, there's some real restrictions on what they can do. It has to be tied to an index. It can't be just, hey, look, it's going to be only 2% for the first year and then 32% in a year after that. There are rules that have to be abided by, and it needs to be tied to some type of index like the cost of funds index, and so on and so forth. All right, okay. Then down here is where we're going to break down the actual interest payments. So whatever we chose up above, let's say we chose a 30-year amortization with a 5-year balloon, and we came out to the payments were going to be principal and interest were going to be somewhere in the neighborhood of 160, 872 bucks each monthly. So you'd pay monthly $872 with the first payment due 1 month after closing. And then if a balloon mortgage, okay, then what you would do generally is you go to the financing portion of the MLS or have it spat out if you go find a program that shows you at 6%, $160,000 note at 6%, it's going to be so much principal and so much interest for a total payment of X. And then you go down to 60 months, it'll start to spit that out, that amortization schedule, and tell you what the balance is going to be in 60 months. And you say that the entire principal unpaid balance, which again, this doesn't note how much that or what the amount is going to be payable in this case, 60 months. Please note again that this is a 60-month balloon. Again, that's just the default. I say up here, this can be standard, but you also see 24 months, 36 months, could be any amount is when the balloon would be due. All right. And finally, if a second mortgage, the amount of the first mortgage shall not exceed the amount set forth in paragraph 2C of the contract. So if you go back to the FARBAR contract, we break down, okay, here's the $200,000 purchase price, here's my escrow, here's how much it's going to be in a first mortgage, and here is what's going to be in a seller-held second mortgage, purchase money mortgage. And so that number, whatever you put in there, if you go back to the FARBAR contract, should match what's going to be here, or it cannot exceed that. And then finally here, this goes into, and this is again newer because of the Dodd-Frank, that there are a lot of restrictions on the structure of the actual mortgage in the note, all right? Meaning there are things that can and cannot be done as far as those are concerned, and what would be allowed and the type of insurance that has to be covered and all that kind of stuff. So whoever creates the actual note mortgage would need to pay attention to that, because the buyer and seller would be agreeing to that. And if they don't agree to that, or if they can't agree to that, then they can amend that. But again, here, I do not want us as agents making any interpretation of that. That's where they should seek legal counsel to do that as well. All right, so hopefully this explains owner financing. It's not done all the time, very rare actually, but again, reiterating that I do allow owner finance deals at Future Home because the deed is being transferred. So that if a buyer puts up 40 grand on a purchase price, at least the deed is in his name, so he can protect his rights under that. And that's why I do allow it for owner financing, but not for lease options when there is no transfer of ownership. All right, thanks.